So, team, what got me started into this business was I was actually a mortgage loan originator. And I found myself spending more time helping people get to a point where they can be approved for a home. Why don't I take my love of education and start teaching people how to handle their finances regularly? So tonight we're gonna go over some steps on what to expect when you are purchasing a home from the mortgage side. And then we'll go over a couple of loan products and down payment assistance. So home buying steps. So step one, most people think when they are going to go buy a home that they need to go talk to a real estate agent. Don't even bother your real estate agent, just go to your lender first. Difficulty. All right, so your first step is actually gonna go find yourself a lender that you wanna work with. If you decide to go talk to a real estate agent first, I'm gonna let you know right now, they are gonna send you right back to a lender because they have absolutely no interest in showing you homes that you do not qualify for. So you're gonna go talk to a lender, they're gonna go over your finances with you, your debt, your income, all of that good stuff. Then your next step with them is gonna be your pre-approval. Typically, most real estate agents will not show you a single home until you are pre-approved. Because you can sit there and be like, well, I can afford in your head, a $3,500 a month mortgage, but the bank might think you are better off at $2,600. And now you spend all your time looking at homes that you cannot afford, nor can you actually get approved for. So they want you to have that pre-approval first. I also want you guys to understand the difference between a pre-qualification versus a pre-approval. Again, your real estate agent is going to require a pre-approval. Pre-qualification is you see your lender, you fill out an application, you tell them that you made $6,000 a month. You have no documents or anything like that, and they let you know, hey, you probably qualify for X amount. A pre-approval, you are going to do your whole application. They're going to look at your credit history, your credit score, your debt, and your income. They're going to verify your income, and they're going to verify your bank statements. And that's how they know that you are good to go for a particular amount. Then you're going to go see your real estate agent. You and your real estate agent are going to have a conversation, what type of home you want, where you want to live, how soon you want to buy. Are you going to max out your pre? Are you going to do something a little bit less than your pre? Once you and your real estate agent have found the house that you just love, you want to put an offer in. Your offer's been accepted. You then actually have to apply for the mortgage. So steps 4 and 5 that are listed are actually kind of interchangeable. Here's why. Once you go under contract, and your contract has been ratified, you are then going to set up your inspection. You're going to have to come out of pocket your earnest money deposit. Maybe you are going to set up your appraisal. You're also going to, even though you've been pre-approved, you're still going to have to officially apply for your mortgage. So your lender is going to ask you for a few more documents, and then they are going to apply for the mortgage for you. What happens after that is the underwriting will take a look at what your lender has sent over in the file, and they will send back something called a conditional approval. So they'll say, buyer, you still need to provide a driver's license, updated bank statements, updated pay stub, and maybe a few more things. From there, although you guys won't see it on your end, your lender is then going to have to jump through some hoops on the back end with the underwriters. We're gonna have to make sure some other things are there in your file. I always tell people underwriting works for the mortgage company. Your lender and your lender's processor works for you. So please always make sure you are telling your lender and their processor everything that needs to be told, because there's nothing worse than us getting to the finish line and finding out you left the information out. For instance, I had a gentleman told me he did not have child support. Technically, he did not have child support, right? When his ex worked something out verbally. Issue is, legally, he still had child support. So I ended up not finding out about child support until a couple of weeks before settlement. And that almost blew the whole deal. So you have to tell everything. You have to show us everything. Closing process. So once underwriting has checked off on all of the conditions that I have to satisfy, or your lender has to satisfy, you have to satisfy, and the processor has to satisfy, along with title. You will begin the closing process. You are going to also need things like your homeowner's insurance. You have to show proof of that. You're gonna have to wire your down payment if you have it. You're gonna have to wire your closing costs if you have it. Sometimes you have to pay off certain debts before you can make it to the settlement table. You'll have to wire all that money over as well. You'll then get a wonderful email or phone call saying clear to close. You'll then set your day for your closing day. Closing day, you're gonna be coming with your ID. And if there's anything else that they tell you to bring, and you're gonna sign all your papers. After that, for post-closing, the lender, the company you're with will eventually send you something in the mail to tell you how to make your payments, when your payments are due. Something that does happen, not often, but can happen, sometimes you will have post-closing conditions. If you don't satisfy that, you technically don't have a home. So for instance, I had a lady that, she went out on maternity leave while we were doing the whole process. And she had to, I think they gave her like another month or something after closing, and she had to show proof of income again, that she was making the same amount of money that she was making before she went out. So if she didn't satisfy that last condition, everything would have been reversed. So please make sure you do all of your steps. So let's talk about some mortgage laws. So you have FHA loan. There's, depending on the company you go with, they're gonna have other programs within these programs. But here's just a broad overview. So FHA is a government-backed loan. You will need a 580 credit score if you want to use the 3.5% down payment. You can go below 580 credit score, but it is going to cost you 10% down payment. So might be a little cheaper just to score back up, but it is doable below 580. You are able to have more than one FHA loan at a time. They have to be a certain amount of distance apart from each other. FHA is more lenient with your debt to income than conventional loans or USDA loans. Those are going to be a little bit tighter with your debt.
Answer the question very nicely. In regards to USDA, periodically, the standards for USDA in terms of places where you go. Have they limited the locations that where people can qualify for USDA?
So it's
Calvert like this rule.
Calvert, all of Calvert County logistically is qualified.
Right.
St. Mary's, Waldorf is not. St. Mary's, there's parts of St. Mary's, majority of St. Mary's qualifies, except for like Lexington Park, or say like California, and maybe like one or two other places that are a little bit more populated.
How about mechanics?
I think mechanics is fine. If you're ever wondering about a property, you literally could go to USDA, go to the map and put a, address in, and it'll let you know. I actually had a client buy a home, so frustrating. The house was, if it had been on the other side of the street, it would have qualified for USDA. The red line went right down the middle of the street. The house she wanted was on the other side. So yeah, they're a little funny about it. So something a lot of people forget about is you do have closing costs when you purchase a home. There's a lot of focus on down payment, but then they forget about the closing costs. So with FHA, you can actually receive up to 6% seller contribution that can go towards your closing costs. That's gonna be up to your real estate agent to negotiate that. FHA has a lower interest rate than your conventional. Has to be an owner occupied home. So it has to be an owner occupied home for FHA. Conventional, so you can't get conventional loan under 680, but the sweet spot is gonna be 680 and up. You can do your down payment 3% down for your very first home. So if you're first time home buyer, it's gonna be 3%. If this is your second home or more, you're looking at 5% down for each home after your first. Conventional has slightly higher interest rates. For seller help, you can ask anywhere from 3 to 9%, depending on the amount of money you actually put down. And they also have higher loan limits. So there are limitations on how much money you can actually borrow, depending on the loan program you're going with. Oh, and also conventional loans are also for investment properties. So that's where that 20% comes in. Down payment. All right, so VA loans. I love VA loans. So one thing a lot of people don't realize is that there is not a credit score requirement for a VA loan. It's all dependent on the lender you're working with. Yep, so they have absolutely no credit score requirements for VA. They're pretty sure they're the only ones that will go over 50% debt to income, just depending on how the deal is structured. There's no down payment. You can ask for up to 4% seller help, and the seller can actually help pay off debt of the buyer to help them qualify, or even if it doesn't help them qualify, to make it go sweeter. That's the only way to do it. So if you're on the conventional FHA, USDA, the seller cannot pay off your debt, VA they can. But your co-signer can only be another VA eligible buyer. Your spouse, another VA, another veteran that is qualified. Just because you are a veteran does not mean you qualify for VA.
Here's the question. Sorry, not myself. I learned so much from someone who is going through that way. And one of the things is, and really how to them people get on their payments. Well, one is a sister. So he's not talking about why she can't be on the loan.
Unless she is eligible for VA or something.
Whereas with FHA, possibly
So the other mortgage loan programs, you actually have multiple, like you can have 4 or 5 people on the mortgage, if need be, to make something work. The VA is the only one where you actually have to do VA. Well, all right, so USDA loans. I actually used this for my house when I bought it many years ago. So it's no down payment. It is gonna be income based, and it has to be in an eligible area. So you're looking at the more rural areas. So Washington DC does not qualify. The majority of PG County does not qualify. I think it's like a small area in Upper Marlboro, parts of Brandywine, maybe parts of Clinton type of thing. The neat thing with USDA is you can actually roll your closing costs into the loan if the home appraises for more than what your actual offer is. So let's say you got approved for $350,000, you found a house that is $330,000, and then the house ends up appraising for like $345,000. You can roll your closing costs in up to that $345,000. That's actually really fine. So I ended up not having, I think I came out of pocket $1,500 for my home. That's it. You can also ask for seller help up to 6%. But with USDA, you cannot have any other properties in your name. It's not a purchase. So if someone passed away, deeded you their home, it's not gonna work. You don't have to be a first-time home buyer to use it, but you just can't have any other properties in your name. Talk a little bit about down payment assistance. So unfortunately, for those of us in Southern Maryland, there is no county-based assistance programs for anybody out there. Your lender might have something specific for their company that they can help you out with. Maryland itself has a Maryland mortgage program, which I think is amazing. I see recently they added, you can do a 2 or 3K FHA loan. So for people that don't know what that is actually a renovation loan. So I always tell people, one, don't max out your pre-approval, and two, if you can't find a home that is turnkey to your liking and get approved, do a 2-3 up. That way you go into the house, you can renovate it, you've now built up equity off the break. And now your house looks the way you want it, right? The paint jobs are now covered through the loan, the new carpets, you know, if you need to change out your toilets because you don't want to sit on somebody else's old toilet, like all that stuff is done and it's not money that's very much out of your pocket. Maryland Mortgage Program will cover up to 5% of your down payment and closing costs. So if you are using VA, USDA, that's all of your closing costs covered because there's no down payment, no down payment programs, right? FHA, conventional, they can't cover all of your down payment and parts of your closing so that you only come up with a little bit for closing. Or if your real estate agent is able to do it, they can negotiate seller concessions to help with those costs. Maryland Mortgage Program is a really good program. So they might not have the sexiest interest rates and you cannot buy the deal, but it's a 0% deferred loan. So you are paying this loan back when you have fully paid off your home, you sell your home, or you refinance the house. You don't actually have to come straight out of pocket for it. It can come out of the equity in the home and you can have it. You also don't have to be a first time home buyer to use this, as long as you don't own a home currently. We have other programs that are like 3% for those that have owned a home in the last 3 years. Free money is good either way. I'll say that. So if you guys are interested in learning a little bit more about it, you can go to usually Google MMP or Maryland Mortgage Program. They'll tell you all the eligibility. You need to have like a 640 credit score at least. Your debt to income, depending on your credit score, has to be anywhere between can't be more than 45% to 50%. Just depends on what score you have. But they're very good programs. I think you max out in Calvert County. You have 2 or more people living in a home. I think you can't make more than $190,000, which I don't think a whole rack of people are making that. So it's a little bit easier to qualify for this as in this county anyway. Other counties like Annapolis, I think it's like a 2-person household, you can't be more than 120,000. So it makes it a little harder. We all know Annapolis can actually be a little bit more expensive. But it's based off of, so we are a suburb of Washington, DC, places like Annapolis is a suburb of Baltimore. So economically.
So you're saying that was people watching that thing?
Yeah, so they have programs, I would say that's called. Yeah, they would, so the same price home here, somebody probably qualified for it income wise, but they couldn't because of just where it's at. Like I had clients think combined, and they found like about just under 140. They were looking at PG County originally, so I didn't think anything of it. They found a house in Gambles. So that's right with the library in Yamato County, and now they couldn't get a mortgage program anymore because of the income restriction for Yamato County. So luckily my company had their own set of down payment assistance programs, but this one is a little bit stronger. Speaking of, so at the time I copied this, these are some of the grants and junior liens that are available in like the DMV area. If you want to take a picture, you can always ask your lender if they have access to any of these. Again, MMP is for all of the counties, so it doesn't matter where you live. MMP covers it. Some of these are going to be just their county or their city base.
Some of these. I recall selling something in Frederick. And the person was able to get assistance from the city, whoever it costs, as well as on the, and he was quite a source for it.
So you can double up for some things. So like, PG County has, PG County has their own program, which they'll give you up to like $25,000. You can couple it with Maryland Mortgage Program if you need. Lenders just gonna have to play with some things, but it is a doable thing. You don't have to come. So, yes, a lot of these things you can double up, stack up on top of each other, especially the grants. The liens, because you have to pay it back, we have an issue of like, going blank today. You have an issue of having to borrow too much loan to value on them. So if you have too many loans for the value of the home, you're going to kind of set it off. So those are going to be a little bit harder to stack on top of each other versus grants and stuff like that. All right, so some do's and don'ts that you will cause your lender to have a hard time about. All right, so please always save. Pay down your debt, but pay your debt down like you normally would. Don't start paying off stuff. You might end up paying off debt that you don't need you to pay off, and now you are short money to close. Now you have accidentally or inadvertently closed a account, which now will drop your credit score, which sounds weird, but and so when you talk to your lender will be able to tell you, hey, I need you to pay this off, I need you to pay that off, keep making your normal payments, maybe pay this down to get your score here, but don't do anything until your lender actually tells you what to do. Pay your bills on time, please do not be late. Understand your credit, understand how maxing out certain carbs, what the change is gonna be when you drop it down to 50% utilization, 30, 10, or keeping a very low balance on it. Do get pre-approved, that is a must. Always inform your real estate agents, your loan officers, of any type of major changes. I remember my boss once told me when I first started, he had a buyer, married couple, husband lost his job, but was pretending to go to work every day, thinking that nobody would catch it. But before closing, they do a review of all your stuff. They came back that he had been to work. So they're gonna catch it eventually. They might not catch it in the beginning, but they're gonna catch it eventually. So just be upfront with your agent. And also, when you have to put up your earnest money deposit, if you do something like that, you might not be able to get it back. Whereas if you're upfront, you talk to your agent and your lender, they might be able to recoup your money that you have to down, you don't have to walk away from it. You're best to maintain employment and income. We would prefer you to stay with the job, but if you do get another job, let it be a better paying job. Make sure you purchase homeowners insurance. They're gonna ask you for that. It's part of your clear close. Please keep records of funds and important documents. Oh, that's what I missed out. So I always tell people once you're ready to buy a home, make sure you can find at least 3 years for your tax returns. Because if you're getting down payment assistance, they want to make sure you have owned a home 3 years. 3 years tax returns. I can't even tell you how many people go to apply for a mortgage and haven't even filed last year's tax returns. Make sure you have access to your last 2 pay stubs. If you get paid bi-weekly, you know, you're dating a month's worth. So if I paid bi-weekly, you need your last 2. If you're paid weekly, we're gonna need at least 4. Bank statements, they're gonna want 2 months. If you are one of those people, if you're one of those people that tends to like to store cash in their house, cash is not king in the lending world. We want to know exactly where that money is coming from, how you got it. I suggest 3 months before you talk to a lender to deposit whatever cash you plan on using. Because we're gonna ask for 2 months bank statements. If that cash is already in your bank account, there's not gonna be any questions. If your lender sees or your underwriter sees that money has now been put into your bank account, you're gonna have to explain where it's from, where it came from, all that good stuff. Make sure you're working with real estate agents, lenders, title companies that you trust, that communicate well with you. There's nothing worse than to go through this process and have somebody that is not communicating their expectations, listening to your expectations, and having your best interests at heart. So some notes: please do not change jobs unless it is for a better paid job. Do not buy a car during this process without talking to your lender first. Changing banks. I have one lady, she had multiple bank accounts, and she often transferred money between her accounts. When I tell you that was the most frustrating thing in the world, because if I get your bank statement for March, and then I see that you transferred money to another account, I then now have to verify that that money went to that account, and then you switch it to something else, and now I have to make sure get a verification for that other account. Please don't change your money while you're doing this. Leave it in your accounts where it's at. Don't co-sign for any loans. There are ways around not counting the debt that you are co-signing for, but again, it's another area that we have to get over. For instance, I had a buyer that co-signed for student loans for a relative. She didn't pay them, so we just have to prove that she hasn't paid that bill for the last year. But still, it was ahead. Then I get, the family members should prove that she was the one making the payments and not my buyer. And but if your family member doesn't know, I don't show you my bank account. I don't show you my bank statements. Now you're stuck because now I have to count your debt as part of your thing. So you just shorted yourself some buying power. So anything large purchases, please don't buy any furniture with the anticipation that you are about to move into the home. And don't make large deposits, because like I said before, they're going to know where the money's coming from. Don't charge excessively on credit cards. Again, credit cards, the monthly payment is going to be based off your balance. So if you are now charging excessively on it, your monthly payment is now increasing, and the your net income is now going up as you buy more things. Don't admit debts or liabilities from your loan application. There's a section that will literally ask you, have you told us all of the debt that you have, and we expect you to please tell us. Yes. Don't buy furniture, appliance, or anything major for the home until after you get the clear close, and still I would recommend that until you've actually signed all your documents. Don't spend large amounts of money in your bank accounts. I had a buyer, I pre-approved him in December. I was like, we're good to go. So like the first is right before Christmas. The first week in January, we got a home he loved. I was like, okay, great. We actually spent $7,000 at this time. And I had told him, it was a looking thing. And I had told him, like, based off of December, we already had an understanding where it's supposed to spend. So he wanted a contract on his house. I asked for updated documents for everything, and so he did not have the money for down payment or clear close. So yeah, that was a struggle. We got it now, so it was a struggle. So yeah, please don't spend the money that we have already seen, that we've already allotted for so that you can close. And don't go having other people pull your credit. So you can do a couple of credit pulls within like 45 days. So if you went to one lender, they did your check, you go to another lender a couple days later, they do your check, you're not gonna have a multiple hit scenario because the bureaus look at it like you're shopping for the best deal. If you go in October and have your credit pull and do nothing, and then have it pulled again in November because you just want to see what you possibly could get, and then have it pulled again later on because you weren't sure back then, your score is gonna keep dropping because you're taking hits every time now because it's past the 45 days. So some things to know. So you are going to have something called an earnest money deposit, EMD. This is
going to ask you a question here. I understand not having handled any other things before credit, but is there any downside to individually pulling the phone?
No. So if you pull your credit, you will never get it. That is consumer pull. You're fine with that. When you have your third parties looking at it, it's the same thing when you buy a car. You can have multiple car dealerships pull, but it has to be within that time frame. Otherwise, it will bring your score down. You're going to get the initial hit, but the subsequent pulls you should be fine once you're in that time frame. But anytime you check your own credit, there's not an issue. But I will tell you, with credit is very subjective. It depends on who's looking at it. So as a lender, a mortgage lender, the score I'm getting is going to be different than what your car dealership is pulling and what they're getting, which will be different from the credit card companies and what they're looking at. So you may very well have 3 different credit scores for each of those things.
So what you say is someone says, okay, I'm looking for a phone, and so my credit score is right.
I would say that's a consumer request. And Credit Karma is great for keeping track to make sure everything's reported correctly. But it is not the score that necessarily the lenders are looking at. Alright, so earnest money deposit is considered like a good faith deposit. You are giving this money up to say, I'm serious about this home. It's typically anywhere from $1,000 up to 1% of the purchase of the home. So if you're looking at a $1,000 home, you're looking at approximately about 4,000 extra rents too. We get it, everybody has that. So that's why I say about 1,000 up to 1%. You and your real estate agent are really going to suss that one together to make your offer seem more appealing. Then you're gonna have your inspection. It's not an end all be all when you have an inspection. I think a lot of people get these and then see that there's things wrong on the inspection report, but the purpose of the inspection is to find stuff. He's gonna find something. You just kind of weigh what you think is tolerable, what you think can be fixed later, which doesn't even need to be fixed. That cost is going to depend on who you go in and what inspections you have. You're typically looking probably more than $300, but you look at $300 and up. And then you're gonna have your appraisal, which is gonna go through your lender. You're looking at $600 give or take, depending on the loan program you go with. So those are the out-of-pocket expenses you're gonna have as soon as your contract is ratified when you buy a house. So again, I already talked about it. Outside of your down payment, you also have closing costs. You're looking at anywhere from 3% to 5% of the sales price, typically where your closing cost amount falls. You can talk to your agent and your lender on 3 ways to have that paid off. It's for paid for if need be. Again, with down payment assistance, grant, selling concessions. A lot of people ask how long does it take to purchase a home. Once you're under contract, it's typically anywhere from 30 to 45 days. You can close sooner, because it's rare, but you can close sooner. You have to be on your A game though. When your lender asks you for something, you need to have it readily available, and it has to be a very smooth transaction. Your minimum credit score will definitely vary based on which loan program you're using. I don't think I said every USDA. USDA typically you want a 640 credit score. You can get down below 640, but your debt to income will have to drop. Again, like it's going to be even tighter for you. And then sorry, too much, but you have to go to something called a manual underwrite for the lender, and it can be difficult. So 640 is your sweet spot where you would be. You are able to buy your interest rate down. A lot of people over the last few years are complaining about how high interest rates are. You can buy it down. Unless you're going with MMP, you cannot buy MMP for down, but you can buy your rate down. So let's say, I don't know what interest rates are right now. If you came back like 6.8 in your end, like you can buy down to 6.2, you can buy down to 6. It's gonna cost you, but it is something that you can do right here. That's what you're gonna spend it. You are, if you are looking at any homes and not coming up to your standards, what you want, please look into a renovation loan. I think they're wonderful. I mean, I know I did USDA for my home, but my house is a renovation. So I work it down, but I bought a house for $197,000. Did a substantial renovation. That house for $450,000 now. Again, I came out of pocket $200 to buy my home. You're not gonna have the same equity buying a turkey house. I like having that beautiful house. I like everything. So that was the route I went with. I think something else that a lot of people don't think about: new home purchases. Your property taxes are going to go up substantially the following year because you have now made improvements on land, so the property is now valued higher than what it was when you purchased. So please keep that in mind when you are maxing out your approval on a new home. And again, you typically don't have to be an actual first-time home buyer to use down payment assistance. They usually say if you haven't owned a home in 3 years, you are considered a first-time buyer. That is my spiel on mortgages. Real quick rundown. My name is Jessica Sullivan. I'm Dr. A. Sullivan Consulting. You can reach me at jessicasullivanconsulting@gmail.com. If you would like to be on my schedule for anything, you can put yourself on my schedule through jessicasullivanconsulting.com. Are there any questions? Anybody want
To pass on a question that I heard yesterday, can you address different types of debt? For instance, the two that I was being asked about are the different effects because of student loans or medical debt and other types of debt in terms of debt ratio that lenders are willing to consider.
So no, that is that index. So if your payment is $300 a month for your student loans and $300 a month for something else, it's the same value with it. Now, if you have medical debt in collections, they will ignore that. I don't know if I'm signing any reason like might have, but before they would have ignored that. They don't look good. Medical debt was no longer affecting your credit score for a time period. I feel like that was changed this year. I have to double check, but that was probably the only one. You can buy a house if you have collections. You can't, please do not pay any collections off. Definitely don't pay any charge-offs off. Company has already, it's a charge-off. The company has already not quite recouped, they've written it off at a loss for their taxes. So they are the square with that. Collections, they might need you to pay it, might not, unless your letter tell you if that's something that needs to be done. Student loans. It does not matter if I want to say, well, my student loans are deferred, I'm not making payments on it. I have to count them as a debt because at some point in your life they are going to come due. So I have to make sure that you can afford this mortgage plus your student loans and your other debts. What else? I know credit cards, you do need at least, I think it's 2 lines of credit when you're purchasing. So they like to see credit cards, they like to see your debt. They like to see credit cards, they like to see that you bought a car before, stuff like that. If you only have your only lines of credit or that you are authorized user of somebody's account, that's not going to work. You need to have also some lines of credit for your own stuff. I am not, I haven't graduated this year. Okay. But I technically still licensed, but yeah.
We're prior to this. Yeah. I'm more just curious about what you're seeing for, for trends in this region for borrowers or like the industry. Are people having a hard time affording homes? Are people in interest rates? Or are you seeing people still having money in the bank and they're still making, we see some still up for 100,000 more than they were last year, and the payments, because the interest rates have been written, people are still buying them. Even if anecdotal.
So I think people that are confident in their income and their jobs have no problem, they're not worried about interest rates, like I said, they might, they might be selling a home, so the cash is already might be available, it's not like this is the first one. Anything that might be first time home buyers that are a little skeptical because they don't know how the process goes, how to come out of pocket with, they have to put directly out of pocket, with the funds, a little nerve wracking sometimes. I know a lot of people still think that it's 20% down for down payments, that scares people away. A lot of people do talk about interest rates. I have a lot of friends that are investors, and I always tell people like investors don't care what the interest rate is. They're gonna purchase a home, they're gonna put you in at whatever market value the rent is, they're gonna refinance and bring the rate down later on, and they're gonna continue to raise the rate on you. So you either pay the mortgage for yourself, or you're gonna pay their mortgage plus some, so that they can go buy another property and put somebody else in it as well. So I was trying to tell people don't stress too much about interest. They go up, they go down, you can always refinance them later on, you feel like you're in a better financial position. But you really just want to get into a property that is a good property. I don't just have buying anything to say that you got something, but buy quality home, build your equity, pull your equity out to do something you need to do, whether it's on a house, whether it's to put your kids in college, whether a lot of things. But you know, that
Would you guys guess using equity to do one year?
you're essentially paying yourself back. What do you do? Get a personal loan, do it, and then pay the bank back. I mean, you can at least put it back into your mortgage, the loan, the lock, cash out refi, any of those. People that know they're gonna do multiple tasks, the lock is probably the best option for them. You can use that credit card essentially. The he loan, the cash out refi would be one time loans. When you're refinancing your whole entire loan, the he loan is almost like a lock, it's a one time second cash loan for you.
But the renovation loan, they were talking about is for someone who's first time buyer.
Oh, to a 15 loan.
Yeah, children.
Yeah, so it doesn't have to be a first time buyer, so, but MMP does now allow for it. So before MMP would only do regular FHA loan, regular FHA, USDA, VA, professional, they've now added the FHA to a 3K. So now you can do a limited refinance or renovation loan. You can't build a whole other structure on the property, but you can do limited amounts of repairs to the house. That's what happens.
I asked on the chat and I didn't hear any